Hello, fellow traders. 'Tis I, the Rumpled One. It's Tuesday, July the 30th. The year's 2019. Let's talk trading. Simple, easy, and profitable. That's how trading should be, right? Should be simple, should be easy, and it should be profitable. Because you definitely don't want it hard, difficult, and unprofitable. But it just seems that it's elusive, hard to attain, hard to obtain. But why is that? What is it that you're doing that makes it so your trading isn't simple, easy, and profitable? I want you to ponder that. It's something that you're doing. As I mentioned yesterday, many traders look outside themselves for the answer rather than inside. So just ponder that for a while. And as you're pondering, just ask yourself, are you using risk and money management when you trade on each and every trade? Because if you're not, perhaps that's why it's not easy, simple, and profitable. Don't even worry about your method, because just about any method can be profitable. Some more than others, but just about any method, including coin flipping. I mean, you can flip a coin and be profitable. But if you do have a method, are you executing and performing the method as you've written? Now, the funny thing is that you've probably been taught or heard about having trading rules and having a trading plan. And you have all these things you have to keep track of. But I guess over time, they start to become habits and you just do it normally. But maybe your trading rules or your trading plan is too restrictive. You might be honing in on one value as opposed to honing in on a small range of values. I want you to ponder that too as you trade. But as always, your money management, your risk management, you have to have that in place. Weekly, 44 pips off the low, 21 pips off the high, and 36 pips above the weekly open. You see here we barely breached the previous week's high and then retreated. And we have 1, 2, 3, 4, 5, 6, 7, 8, 9 gaps to be filled. But with the news on the pound, I wouldn't be looking for these gaps to fill because it seems like based on the 200 or more pip drop from the weekly open, I don't think the pound pairs are going to fill that gap unless there's some news that rockets them up about 300 pips. And you can see here how many pairs are above the weekly open, how many below. And if you use that as a buy zone, you can see what kind of profit you could be sitting on at the moment. Speaking of the buy zone, as you can see, we had the pivot below the daily open. So therefore, we were short biased. So we would have ignored these long triggers. As you see, price came back through the daily open and towards the weekly open. So right here, we had a short trigger. We didn't even hit the stop either being above the daily open or in the buy zone here. We did not hit that stop. Came through, hit the pivot, continued. And you see right here where price didn't make a new low from this point. Should have exited. You got a second chance to exit. Price came back to the pivot. Now somebody was asking me about pivots, how to trade pivots. A couple of ways you can trade pivots. Number one, from the open to the pivot. So you want to trade toward the pivot. So in this case, you want it to be short. So as soon as you got a short signal, you would take that and then you would take profit right here at the pivot. That's one way. The other way is to wait for the price to hit the pivot and then trade a breakout, like a buy zone around the pivot. Maybe you trade, give it a couple of pips one way or the other, take your trade, place your stop accordingly, and see what happens. You can always trade the pivot as a crossover. So here it crossed below, here it crossed, barely crossed above, here we barely crossed above, here we have a cross above. So those are the ways you can play the pivot, either towards it or when it gets to it, away from it. And here ranges 1, 2, 3, 4, 5, 6, 7 over 100. Another nice day of volatility with the euro yen clocking in at 50 pips. As you can see, it broke out of the previous day's high. It's about an 8 pip break there. Now notice we had an outside bar, followed by an inside bar, followed by an outside bar. Just for those who like to look at these chart patterns. Here on the Einstein line, you can see we were breaking into new territory. Small profits to be made here. Basically just a pip or two. Sometimes that's all you get. And all you have to do is once you enter the trade, if you see it switch from buying to selling, you can exit and just take the money off the table. Looking at the range, again, average range on the hourly, just above 11 pips. But notice, over the last 100 bars, 36 bars were above the average and 64 were below. So once again, you don't want to try and be too greedy. You want to take profit when it presents itself. Price action, you can use the 3-level ZZ indicator. In fact, the trader asked me about 3-level ZZ, and yes, as you can see, it's still on the chart. Still something that I use on some of the charts. Here we had a bar that opened and didn't range out of this area. Here we had a bar that didn't range out of this area, but you see the other bars are ranging out of the area. Just something to note, something you can exploit for profit. Sometimes a little, sometimes a lot. Using the TROHL5 indicator to mimic the wick zone, you can see here we had the upper wick zone. There was the shoot out. Here was the shoot down below. Once again, so here's the day, starting the day, you see we had that upper wick zone price action. And price doesn't like to stay in the wick zones, and you can see that easily. Now, I want to show you something. Traders, I know some of you like to put squiggly lines on your charts. Some of them have the moving averages up in here. You have a bunch of other different things and PSARs and all that kind of stuff. And then you have stuff down here. But do you really need it? We're looking at a daily chart. Let's scrunch it. Okay, this was the beginning of the year right here. Okay, and you see what price is doing recently. Let's expand the chart. So if you look here, just last week, you see price made the lowest point in the year, except for that day back here, right? And then you see price came and crossed through the previous day's wick zone. Okay, and you see right here, this wick zone, it's almost lined up with this daily open. See that? Or I'm sorry, with the weekly open right here. So do you need a squiggly line to tell you to buy or sell? Do you need an oscillator to tell you if things are overbought or oversold? We can switch this to the weekly chart. So once again, there is the beginning of the year. And just look at the weekly. You see here, price came way down here to this level. And then it retreated. So would you buy here or sell here? If you look at how is price moving, well, it was down, then all of a sudden it became green. So obviously there were buyers here that pushed the price up. So when you come to this week, you see it barely got in that zone and crossed above the weekly open. It should be obvious, right? You don't need an oscillator or a moving average to tell you what to do. You can just look at the candles or the bars. You can switch back to the daily. Now you know price needs the range for the week, right? And you know what that average range is. I think I showed you earlier in the week. If not, we'll probably see it sometime. Actually, I think I have time here in today's chart, so we can just switch over here to weekly. Average range, 210 pips. Okay, current range, 65 pips. 100 bars above 65. That means price, most likelihood, it's going to either go higher or lower. Looking at the candles, looking at where it is to the weekly open, bets are on higher. It doesn't get any simpler than that. And you see here, average plus low. If you take that average and add it to the low, that's the target right there. Oh, in case you're wondering, I believe that comes from the 2013 range gauge. Yeah, that plots that line for you. But you don't need that indicator to plot the line. You know what average range is. You've got probably have an average range indicator somewhere. All you have to do is just add it to the low. Stick it on the chart or put it on a post-it note. Know what that target is. It's not rocket science. It's not higher math. It's simple addition. Why do traders make it hard, difficult, and unprofitable? And what's really interesting, you see these guys putting the webinars every week, every other day, and they just keep talking about this method, that method, the latest method. I mean, the methods that I show you, I've been using most of them for over a decade now. Some have been refined over the years, not much, like the buy zone, still the buy zone. You know, the wick zone, I've done some work on that. The rat zone, still the rat zone. But, you know, maybe those other guys' methods work. But all you have to do is trust your eyes and just look and see where price is in the relation to where it has been. Here on the monthly, you see we've got a red month. You see where price is in relation to previous months. All you have to do is look at the chart. And remember, it's not what you trade, it's how you trade it. So train the banks.